Hey everyone, today we're going to be talking about how we can make money trading more risky names around earnings. We've talked about, safe names like AMAT and TSMC and things of that nature, names that don't really move a ton on the earnings announcement. They rarely have blowouts. But we haven't discussed names that do have blowouts. And one of those is going to be Coinbase. So without further ado, what we're going to do today is we're going to go through looking for these, identify what is important, what is not important, weighing if the risk reward is there, and then, of course, structuring the trade. So let's get into the meat and the bones here. As we can see with Coinbase, a couple things. One, you scan it like anything else, right? Implied versus average is coming straight down. And what we see is that we have an implied move of 16.5% with a realized move of only 8.5%. It's almost double. Ratio of 1.89. We also have an implied versus average implied of 1.23. Huge discrepancies across the board, right? But we've talked about names before that are blowouts, right? That have huge risk, huge implied moves. Like, I don't know, Snapchat, right? You can see that Snapchat is implied moves of 20%, 18%, 17%, 22%, 20%, but it's realizing as high as almost 60%. And it's a huge loser. Some of these were losses north of 140% on one trade, right? This is something that we don't want. Now let's go back to Coinbase. We can see the P&L on Coinbase is completely different, right? It's actually profitable to be short on this thing around earnings, which is good. That's one of the criteria that you want. If it's a higher risk name, the risk in itself could be overpriced. Think about it like Walmart, Target, or Google, right? We know that there's premium there. We've seen it, right? But the spread between the implied and average, that level of premium, is not nearly as high the ratio as this, right? In terms of absolute volatility terms, right? The amount of implied volatility around the earnings event versus what we think it should be is much higher. And what we can see though is that this has been profitable. Now, granted, it's only been 6 quarters, but during those 6 quarters, selling volatility around Coinbase has been profitable 5 out of the 6 times, and its biggest loss was 8%. Now, granted, this is a small sample size, but it does show a pattern. Continuing to look at the data that we're looking at, what another thing that we want to see is we want to see implied moves coming up, right? Usually, this isn't perfect. I'm not saying always, right? But if the implied move is coming up recently, then there's probably something driving it. There's probably it's probably easier to figure out why the market is fearful. And if we can determine that the market is over exaggerating, well, that just adds to the cake, right? Lastly, I like looking at the earnings move distribution. Now, what you're going to notice is that the blue curve right here is the implied move, right? And these green curves are the realized move. This is why the premium exists. Because look at this on the right here. You see this blowout on the green, right? Talking moves of 25%. That is why we get paid. That blowout risk, right? We have an implied move standard deviation, right? The average difference, between every single one from, the distance between the mean, the average, 5.5, that realized move is almost double. The risk is extremely high, right? And that is why we get this compensation, right? That's why we get this premium. Again, though, comes back to, well, quantitatively, this looks great, right? Question is, why are we seeing this implied move rise, right? Why is the risk here? Well, a couple things I think it is. One, I think it might be retail. Now, while we're not seeing this on swaggy stocks in the last 24 hours or the last week on Wall Street Bets, right, which is the best money to be betting against, we are seeing an uptick in message volume, sentiment, and things of that nature, stock twits. And Coinbase has 100,000 watchers or so. So there's a lot of retail that likes this thing. It's one of the most talked about names on any financial media source. Next, another thing I think this could be is due to just the overall market risk, right? That's had some really bad quarters recently, right? In Q1 2022, forecast EPS was a profit of 35 cents a share, came in at almost $2 loss per share. Q2, kind of the same thing, big blowout to the downside. Q3 was a little bit better, only missed by 20 cents. But again, the market is forecasting similar. If trend continues, it's probably going to miss. Lastly, this could be also due to recent events such as Do Kwon being fined by the SEC. A lot of fear and uncertainty going on in the crypto market right now, whether you want to talk about you know, Do Kwon, like I just said, stashing 10,000 Bitcoins while Terra completely blew up and customer funds lost everything, or you want to talk about, what's going on with Binance or et cetera, et cetera. It could all be that too. It could also be just excitement or fear at the same time due to the recent crypto run up. There's a lot of things it could be. But the thing is that warranted? Based off the realization of the data, no. Based off the fact that these risks have been here with Coinbase before, like, last 2 quarters, huge misses, right? It hasn't even come close to realizing. I mean, it's for 2 quarters ago, it was basically one half of what it implied, and for last quarter is almost a third of what it implied. Great stuff. So, structuring the trade, right? Just for reference, Coinbase reports their earnings, as you can see here, on February 21st after market close. It's going to be Tuesday after market close. Now, structuring the trade, really going to be the same thing as everything else. If you want to capture the edge as much as you can, you guys know how to do that by now. It's selling the closest dated options that are going to see the event. So that would be next week's weeklies, right? So the February 24th expiries at the money straddles, right? Now, here's just a little risk profile. You're going to see these slices right here, the break evens at 77 and 3/4 and 52 and a quarter or so. And then average move, and then putting in the average move price slices, we could expect a P&L after volatility comes down, after the event's been realized. If we get that realization of the average, P&Ls can be as high of 300 plus on this thing. Now, if you factor in time decay, right, because this is obviously going to be after the earnings event, well, now we're talking north of 500, right? Now, obviously, you're going to put this on, theoretically speaking, right before the earnings event, so there's going to be some time decay that already wears off beforehand. Nevertheless, though, still looks amazing on the risk reward profile. Now, I will say that some people may not feel comfortable making this type of trade with this in the cards, right? With this in the cards, right? So one way you can hedge this, of course, is with Condor, right? Now, all you really have to do is just make sure that the skews are not completely out of whack, right? So looking at Coinbase's skew, we can see we have your classic smile, right? The skews, basically how much more expensive puts are to calls, is exceedingly higher the further you get out of the money on both sides, whether you're talking about calls or you're talking about puts. Now, what that basically means is that if you're selling straddles, which are at the money, which is here, and then you're buying the wings, right? You're buying the wings at 170 and on both sides and selling at 166. Now, yes, in dollar terms, that's going to be cheaper. In volatility terms, you're actually selling more expensive. So maybe that's not the best view to reflect. Maybe it's just better to tone down the size, right? Here's an example. Say you sell one straddle and Coinbase blew out, right, to let's say 95. This is going to be a $1,600 loss. That's true. But what happens if, I don't know, I sell an iron condor, right? But I tone up my size because, well, now I don't have, infinite downside risk. I don't have, infinite risk. Okay. So again, same ordeal here. Let's say that we sell 66, right? Then we buy, let's go 12, 70, let's go 75 and 65, 55, right? Now, watch what's going to happen here. Also, wow, they should be the same. All right. Look what happens. Right? Now, obviously, this is going to be skewed just a smidge, right? Just a little bit here on the skew side of things. Actually, no, it's 57. Yeah. Okay, so you're going to notice, oh, well, my risk reward profile is great, right? Just for reference, by the way, guys, condors, it's at the money put, at the money call. etc. You guys probably know that. All right. Actually, you know what? Just for the sake of it, I will actually do it like that. We are gonna get this entirely right. So we're gonna sell that. We're gonna sell that. Let's go 5 deep, and then we'll go 10 out, 10 wide. Okay. Thank you guys for staying with me here while we get that in. Oop. All right. Voila. Okay, so here's our new and improved condor. Once I take this off, right? You're going to notice that, oh, well, my risk reward is high and my loss is capped, right? But look at how much you're going to lose, right? You're going to lose, give or take the same amount. You're also, look at your break evens here. Break even, if you held all the way to expiration, 72 and a half, 57 and a half, give or take, right? Go back to the straddle and remember those numbers. Go back to the straddle. Look at your break even. Your break even before, right? Your break even on the condor, right? To the downside. If we go back here, was 57 and a half. Your break even on the straddle is 52 and a half, right? So if you're just saying that the implied move is more overpriced than what it should be, and that the average move is going to be lower than the implied, then you want that threshold to be around the 16% mark. You do not want it to be, 10% or 11% because that's not the view that you're expressing. Unless, of course, that is what you think, and you do think that you're going to see, an 8%, right? However, the range at which you can make money, the range at which is profitable decreases. So this, I can't stress this enough. This is really where it comes down to your own levels of risk tolerance, your own views, and what you think is going to happen, right? And that's one of the things we're going to discuss in later videos. So, guys, that is all for this one. As always, please do your own research on this. This is really just an example that the optics look great to discuss. Do not take any types of these trades unless you've conducted your own due diligence, your own research, you've measured out the risk tolerances, and you're comfortable with it. This is really more for learning purposes. Now, as always, guys, if you have any stocks that you want us to take a look at, feel free to comment them down below. And if you guys have any questions, feel free to message me or comment below as well. And I will see you guys in the next one. Peace.